Most people don't lose money because of bad investments. They lose it because of 5 very common fixable system errors that silently drain their wealth. Give me the next 6 minutes and we are going to fix all 5. By the end of this video, you will have a fully automated, bulletproof financial setup. But we're doing this together. Stop passively watching. Treat this as a real-time tutorial and follow along step by step. Open a new browser tab, pull up your HR portal login, grab your bank routing numbers, and have your social security ready. Taking 5 minutes to prepare right now is the only difference between losing money by default and building wealth by design. Step 1. We need to secure your free money. The single most costly mistake beginners make is not getting their full employer 401k match. Log into your HR portal right now and find your exact employer match percentage. This bar chart visualizes exactly why this matters. Let's say your employer matches 100% up to 3% of a $60,000 salary. That is $1,800 in free compensation every year. Over 30 years with standard market growth, that unclaimed match compounds to over $300,000. If your contribution is set to 0 or anything less than your company's maximum match, change that number right now before you continue this video. Leaving that match untouched is the exact mathematical equivalent of refusing to accept part of your own salary. Step 2. We have to stop the inflation bleed. Keeping all your savings in a regular bank account is actively costing you money because traditional banks pay a negligible 0.01% in interest. Meanwhile, inflation runs at around 3 to 4% every year. That means every single month your cash sits in a standard checking or savings account, it loses purchasing power. Open a new tab and start an application for a high-yield savings account. To keep it simple, choose Marcus by Goldman Sachs, Ally Bank, or SoFi. The math is clear. $10,000 sitting at a traditional big bank earns about $1 a year. Move it to one of these high-yield accounts, and that same $10,000 earns $400 to $500 a year. Moving your cash takes 10 minutes, carries 0 risk, and is the only mathematically viable way to outpace inflation. Step 3 is opening your investment engine. The most common fallacy that paralyzes beginners is telling themselves they will start investing when they have enough money, like $1,000, or after they get a raise. You only need $25 to start. Go to Fidelity or a similar broker and open a Roth IRA right now. This dual bar chart compares 2 investors to show you the cost of waiting. Sarah started investing just $300 a month at age 22. Mike waited until he was 32 to start. Even though Mike contributed far more of his own money over time, he finished with $255,000 less than Sarah at retirement. The dollar amount you start with matters far less than building the habit of consistent investing. Time is the heaviest weight in the compound interest formula. Starting today is a non-negotiable requirement for building wealth. Step 4. Now that your account is open, we need to buy the right asset. Every beginner gets tempted to pick individual stocks, hoping to find the next Apple or Tesla. Professional fund managers, armed with elite resources and massive teams of analysts, fail to beat the market 90% of the time over a 15-year period. Inside your new Roth IRA, search for the ticker symbol VOO. That is an S&P 500 index fund. Select it and execute a buy order. Set a hard rule for yourself right now. If you want to experiment with individual stocks, limit it to 5 or 10% of your total portfolio. Money you are entirely okay with losing. Putting the majority of your money into broad, low-cost index funds guarantees you capture the market's overall returns, completely removing the massive risk of stock picking. Step 5. Automate the entire process and walk away. Turn on automatic monthly deposits in your new brokerage account. Setting up this automation is a psychological necessity. It removes your ability to make emotional, panic-driven decisions during inevitable market crashes. When the market drops 30%, like it did during the 2008 financial crisis or in March of 2020, your brain will scream at you to sell everything. This line graph maps out market recoveries following severe drops. The deep plunge you see locks in permanent losses for the people who panic and sell. But for the people who stay invested, that plunge is quickly followed by an aggressive green line of recovery, blowing past previous all-time highs. Automating your system is the ultimate safeguard against your own fear. Time in the market always beats trying to time the market. Let's look at your new baseline. If you followed along, your savings are now earning a 5% yield. You are capturing your entire 401k match, and you are automatically buying the market every single month. By completing these 5 steps, you have officially placed yourself mathematically ahead of 90% of investors in America. You now have an automated system working quietly in the background, fully insulated from the chaos and anxiety of the typical investor trying to guess what the market will do tomorrow. Let me know in the comments below, which of these 5 steps did you finally fix today? Hit the like button if this helped you, and subscribe to Wealth Simply for new videos.